This is Chuck Carnevale. I'm the Chuck in the Markets of Chuck, and today's blog was titled Buying Earnings, Not Stocks. And the idea here is to show how important earnings really are to the investment process because, in the long run, earnings do determine market price. Let's look at a company like Medco Health Solutions. It's been public since late 2003, and during that period of time, their earnings growth has averaged over 20% a year, 22%. And I was only talking about, 15% in the blog. So what's happened is earnings have gone from 86 cents, and of course, if they doubled, that's $1.72, and you can see they went past a double somewhere, between 06 and 07. Their earnings growth went from 86 cents to $1.66, and as you can see, the stock price has rallied from the teens, and out here now it's in the 30s and 40s, and it's actually currently trading at 50. So what's happened here is you've had earnings growth, and of course the stock price has followed that, even though it's somewhat volatile around that. The bottom line is by getting the earnings growth, you've had real value being created. Now let's move on. Let's look at that from a forecasting point of view. The current forecast is 18%, a little less than the 22, but still a very good number. So if you bought Medco today, this is the black line, it's trading at 21 times earnings, just a little bit above its growth rate, and it's currently estimated to earn $2.80. Well, to get a double there, you got to get out to 560. So if you go out, later in the years here, you're going to see by about 2013, you're going to have somewhere between 540 and 636, which is your 560. But here's the point I want to make is, as long as you get this earnings growth, and if you get out here, say, to the end of 2013, and you've got this earnings growth, even if your price-earnings ratio fell, to 10.8 times earnings, which is, here's the scale here, which would be the second blue line from the bottom, you'd have a $58 and $21 stock that you would be buying back here for $55. So even if the market is really poorly capitalizing your company, you would still make money. Now, if it was trading at 18 times earnings, you'd have a $106 stock. You got one more year, out to 2014 at 18 times earnings, which is a lower price earnings ratio than you paid. You have $1.14. But if we got down to half the price earnings ratio, or roughly 10.8 is roughly half of 21, you would still have a $68 stock. So you would still make money even if the market was undercapitalizing your stock. The key is you're buying earnings. If you can get the build up in earnings, if you buy the right companies that are growing earnings for you, in the long run you should do well even in bad markets. Of course, in good markets you do extremely well. The better the growth rate of earnings, the more chance you have to make money, and the less risk you have in the long run because you just have so much more earnings in the future than you bought today. It's Chuck Carnevale saying, hope this gave you some additional insights. Look forward to talking to you again tomorrow. Thanks for